Yes, sir.
Okay, great. Thank you. Thank you. So good evening to all. And as Sumit was mentioning, today was supposed to be the penultimate day, but maybe the topic, audit conclusions, God designed it that let this be the last session for this audit Pathshala this year. Extremely happy to be part of this community and this association's event yet again. And more so on an important topic considering the audit season ahead. As far as these standards which we will discuss now are concerned, there have been no amendments per se. It's the same as what was there last year. But I'm sure with each year passing, there are experiences which increase, and it is that experience sharing which will be the value add. So this series standard, the 700 series, which deals with audit conclusions and reporting. Essentially, there are 6 standards, and this is the finished product of the entire work of audit which is done, which predominantly is the 300 series, 400 series, and the 500 series, which are there. The 300 and 500 series work which is done. So before I get into details, what I would do is set a little bit of context and then go through a standard-wise introduction. A small disclaimer, since all of you know, I have some active work which I do at the Institute's boards. Whatever I share are my personal views and my professional experience. None of it should be seen as views of the Institute. So beginning with setting a little bit of context, I will spend a substantial amount of time on SA 700, 705 and 701. 700, 705 and 701. And I will share with you my experience in FRRB, in QRB, and in the research committee where we have this awards which we give for the best presented financial statements. Between these three, I had the opportunity of reviewing almost 800 plus financial reports. And it is that experience which I will share with you. This is a set of 3 principles which I have practiced right through my entire professional career. I'll just spend time on the third one. Some of you have heard me earlier. Probably you'll have to bear with me for the repeat. But I've strongly believed and practiced these 3 principles. The third one is that the financial statements and the audit opinion, and today's topic of audit opinion on financial statements is a communication. We need to recognize that audit opinion is a communication which we do. Just like each of us in our personal life, professional life, even when we go and interact in sections of the society, all of us have this expectation that when we receive communication, we have the expectation that the communication we receive has to be truthful, and we have this expectation that the communication has to be complete. Each of us have this expectation. So when a family member shares with us, or at office a colleague shares with us, we all have this expectation. The same is true for the communication which we make also. Any communication we make should also be candid. It should be clear and it should be complete. It should be candid, truthful. It should be clear, no ambiguity, and it should be complete. I'll just recall the words of the founder president. Again, some of you have heard me on this, would have heard me earlier, but for the benefit of those who are listening to me first time, I'd still like to drop on this because I'm so much bought into this gentleman's vision for the institute and his various thoughts on which the whole institute has got built. The first part of this slide, which you see, it says that every learned profession should have a sense of social purpose and social obligation, and it is more so in the case of accounting profession. What he means by this is not the planting trees, drinking water, and all that kind of stuff. What he so beautifully articulates is the work which we do, be it the preparer as a preparer or be it as an auditor, the work which we do has so much of impact on the society. The public rely on the financial statements, the banks rely on financial statements and give credit, investors rely on it and give the risk capital. And if something goes wrong, the loss is effectively borne by the public. And that's an obligation we all carry. So when we do our work, we have this huge obligation towards the society. It's not towards the client who is paying the fee. My principle is super clear. Wherever a work is mandated by law, whether it is Companies Act or any other law, that particular work, even though the client appoints us, client pays the fee, such mandates, the obligation is to the society. Then there are due diligence, etc. There are assignments which you do specifically for the entity. So those cases, it is the entity who actually has to be, whose interest is to be taken care of. Now, as far as the standards of auditing is concerned, the standards of auditing today as it stands are law. Whether it is auditor or the preparer of financial statements. For both of us, it is effectively company law. While they are all issued by the Institute of Chartered Accountants of India, the transitional provisions under the current Companies Act have blessed it with the authority and they constitute the standards under the Companies Act. So they're no longer standards issued by the Institute for members. They are standards notified under company law, and the entire legal provisions or legal framework of company law in terms of the way you apply it and the penalties for offenses, all of those under the Companies Act will apply. And then we have couple of important things which I will call out here. There's so many things we need to keep in mind as far as the ecosystem is concerned, but couple of things I'd like to call out. One is relating to the rotation of auditors. Rotation of auditors, we have come to live with it now. And when the rotations are happening, some of us have already seen one rotation, some of us are seeing the second rotation, depends on which cycle we were all there. And in the rotation of auditors, when there's work is moving from one firm to another firm, there are instances where the views of the firm who is taking over could be different from the views of the firm who had earlier undertaken the work. So it's extremely important that we should be careful that we are applying the standards. We are applying the standards the way the regulators actually view the entire set of standards and not an individual's understanding of the standards. And with rotation of auditors, we need to be extremely careful about it. The second thing which I would like to call out is the developments around the regulatory ecosystem. the NFRA in particular, which all of us are aware. And if you recollect, since last October, NFRA has also started a practice of issuing circulars and asking the auditors to bring those circulars to the attention of audit committee and get the same recorded as part of the audit committee minutes as well. So the regulatory oversight is only going to increase, and it is healthy for us. I see that bit of regulatory oversight, particularly engaging the audit committee and the auditee. I see it as an empowerment for the practicing professional, because more often than not, as an auditor, at times, despite the SA 200 series, independence, objectivity, the ground reality is there are times when the auditors find it difficult to express themselves. And with NFRA empowering the auditors to communicate with the auditees, I think it's a very positive sign, and it will help the quality of audit to get better. I'm just sharing a few slides here, more from a context setting point of view. Findings of the Quality Review Board in the period 2016 to 2019. Some of you might think, why are we taking that old period 2016 to 19 when we are now in 2025? The reason is, until financial year 2019, all the listed company financial statements were reviewed by the QRB of ICAI. After that, the listed company reviews have moved to NFRA. So today QRB does only unlisted companies. And annually QRB publishes a report on its findings. But the few slides I'm going to show you now are all relating to the listed company reviews, which have done by the Quality Review Board of our institute. And I have been a member of that for 3 years. And the quality of the work done by the QRB review groups, and the QRB reviewers has been nothing short of exceptional. It's been very good quality of work which has been done. And in this backdrop, I'll share with you the findings of the QRB and my own experience of continuously reading the financial statements of various entities. I don't think these findings have changed materially in the last 6 years. They have not changed materially. And QRB review, just for the benefit of some who may not be aware, we call it a hot review versus FRRB, which is a cold review. In FRRB, the financial statements are randomly picked by the institute, and the review is done within the institute itself. Whereas in a QRB, it is again a random selection process. There's a defined process to do that random selection. But we engage a very experienced auditor of 15, 20 years standing of audit of that particular industry. So if you are having a review of a steel plant, the review will be done by somebody who has actually audited another steel industry. So you get somebody who has already an industry experience, and he is allowed to also engage a support person. He actually goes to the auditor's firm, sits in the firm, accesses all the working papers for about a week. He can even extend it by other week. And the way the audit papers are seen is they should be self-speaking. So they don't want to ask the engagement partner as to how he has done it. So audit papers have to speak for themselves. That's the expectation. So after this review is done, it comes to a group, and from there it goes to the board. This is the outcome of this period. And as we speak today also, I don't think this has changed much. Just look at the right side of the slide. Improvements required is about 55%, and significant improvements required is 7%, which means 62% of the engagements which have been reviewed, there has been scope for improvement. There have been scope for improvement. For a profession which is matured for about 70 years, and please note these are for listed companies. And in these companies, if we are saying that 62% of the cases there is scope for improvement, we just need to do that introspection within ourselves as to why is this situation? Can this 62 become 26%? Can we transpose the numbers? 62 become 26% within the next 5 years. So we need to work on that kind of a plan. And events like this are basically for sharing the findings so that we all can collectively work towards improving the same. And as far as the observations are concerned, most of the cases, the observations have been around SQC1. Many cases, firms don't have internal quality control procedures. Second is wherever they have quality control pages also, it has been a case of copy paste. Many cases, the audit planning related documents are not there. Risk assessment is not to be found. And even on reporting, which is the topic for our discussion today, look at the right side of the chart, SA 700, 706 and 720. 720 also I'll tell you. Even on reporting standards, there are so many gaps which the reviews have ascertained. With this little bit of context setting, let me straight go into the standards. These are some key terms. I'll just read them out because as I go into the subsequent slides, it should be easy for all of you to connect. Key audit matters, financial statements, just look at those abbreviations, you can connect them, these are all very familiar ones. Those charged with governance, basically audit committee or board, professional judgment, emphasis of matter, other matter, management, risk of material misstatement, and financial reporting framework. These are the few abbreviations which I have used in the presentation. Now let me come to the first of the standards, which is SA 700, which is the principal reporting standard. So the entire work which is done from audit planning, assessment risk, and developing doing the audit, getting the evidence. SA 700 is the finished product. And this particular standard deals with the auditor's responsibility to form an opinion on financial statements. So it's not a matter of choice for him. He has the responsibility to necessarily form an opinion on the financial statements. The standard also deals with the form and content of the audit report. And this standard, as all of us know, is only with reference to unmodified opinion, what all of us commonly refer as clean opinion, clean report. If it is a modified report, then we address it as per SA 705. And this standard applies to audit of general purpose financial statements, and also special purpose financial statements prepared under SA 800 or an element of financial statements of 805. And the idea is to promote consistency and comparability the way the audit reports are seen. All of you are aware, our audit standards, SA, are all based on the corresponding international standard of audit issued by IAASB. So every single audit standard we have today is almost a Control-C, Control-V of the corresponding international standard. except couple of standards relying on the work of other auditors or the joint audits. Except those, particularly standards like 700 series, they are complete copy paste of the corresponding international standard. So this particular standard begins with setting out the objectives of the entire audit. First and foremost is to form an opinion on the financial statements based on the work done by the auditor and the conclusions which are able to draw from audit evidence. The key is the conclusions which you are able to draw from the audit evidence. So it should not be conclusions which you form by your own judgment or assessment. The conclusions need to be drawn from the audit evidence and express clearly with a written report, which also describes the basis on which the opinion is formed. How did you arrive at this opinion? Whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. Financial reporting framework, as all of us know, we have two frameworks: fair presentation framework and compliance framework. Fair presentation framework, we have three frameworks in India, again within that. Two of them notified under Companies Act. One is the Companies Ind AS rules, other is the Companies Accounting Standard rules. And for non-companies, we have the standards which are notified by the institute. So the objectives of the standard is to guide the auditor in forming an opinion based on audit evidence which he has gathered and express clearly an opinion with a written report whether the financial statements are in accordance with the applicable reporting framework, and to give a reasonable assurance that financial statements as a whole are free from material misstatements. So this particular audit report is a reasonable assurance report. And some keep asking why reasonable assurance, why it cannot be an absolute assurance. It cannot be an absolute assurance for the reason that financial statements by their design involve estimates, they involve judgments. So given the fact that there are estimates and judgments on almost every element of your financial statement, whether it's balance sheet or income statement, almost every element, there are estimates which are used and judgments being made. You can never have a situation of a mother promised an absolute assurance to be given. It can only be a reasonable assurance. Now, this particular standard, as I told you, it deals only with issuance of what is called an unmodified opinion, what we all commonly refer as a clean report. And this opinion is in the context of financial statements which are prepared according to the applicable financial reporting framework. I mentioned a few minutes back that there are two frameworks. Fair presentation framework, which is what all of us majority deal. And compliance framework is a framework where you do an audit as per a requirement specified in that particular specific legislation. So that particular legislation requires a set of accounting treatments, a set of assurance. That is called as a compliance framework. In a fair presentation framework, the audit opinion which we give carries the words true and fair view. Whereas in a compliance framework, it says that these financial statements are prepared in accordance with this particular legislation. It does not use the words true and fair view. Now, this is a very important slide, and I will go a little patiently. This is a beautiful flow chart, and many of you would be familiar the way the whole SA 700 has been drafted. My view, any audit engagement partner, before they sign off, this one chart if you can ensure that this one chart, all elements are taken care of, it is highly unlikely that there will be any material loose ends which you will leave out. The first requirement before you sign off is, do the financial statements adequately disclose all the significant accounting policies which are there, which have been followed. So that's the first requirement. And my own experience, there are many financial statements which I come across where accounting policies have not been spelt out properly. They have not been spelt out properly. Some cases, copy paste from some other audit client or some other public domain, copy paste, something gets missed out. Second situation, this entity, for example, did not have any investments till last year. So there is no accounting policy relating to, let us say, AS 13 investments. But this year, company had some surplus money, it had some investments. So when you carry forward the previous accounting policy, copy paste previous year or use the same file last year, this policy you forget to add. So this kind of errors are extremely common. They're not rare. They're not rare. They're very, very common mistakes which are there. So what is important is the first checkbox is, are all the accounting policies disclosed? For Ind AS financial statements, many of you will be aware, 2 years back we had a amendment. For Ind AS, there is no requirement of disclosing accounting policies. In Ind AS, there's no requirement of disclosing accounting policies. It was amended to say that you disclose only material accounting policy information. So you only need to identify those are the accounting policies which are material to the entity and the way you have applied that particular policy. That's all you need to do as far as Ind AS entities are concerned. The second thing which the auditor needs to satisfy herself or himself is the consistency and appropriateness of accounting policies with the financial reporting framework. So whatever policy you have selected, is it consistent with the accounting policy framework, the accounting framework, and is it the appropriate one? I'll just give you an example of this. When it comes to consistency, what you actually choose as a policy, is it the same in the financial reporting framework? I'll give a small example. Again, a very common mistake. Take, for example, investments. Investments, we have current investments and long-term investments. Current investments, the language in the standard is the investments are to be carried at fair value, lower of cost and fair value. Market price is at best only an evidence of the fair value. But there are many cases where people write investments are valued at lower of cost and market value. Market value is wrong. It is only fair value. Market value is only an evidence of fair value. Similarly, the choice of word, lower of cost and, it is not or. So you need to ensure that these things are consistent with the financial reporting framework. That's what we call as consistency. Is the words, is the way you have written and the way it's there in the framework are the same. The second is appropriateness. When it comes to appropriateness, take for example something like inventory, something like depreciation. When you are applying a policy, you can do first in, first out, you can do weighted average, etc. Now, when you FIFO or weighted average is not a matter of choice, I can do whatever I want. No. FIFO is to be applied in a certain behavioral situation. Weighted average should be applied in a different behavioral situation. If prices show a particular trend, then it has to be FIFO. If prices tend to fluctuate, then it has to be weighted average. Then there is specific identification method, etc., etc., several. So the appropriateness of the policy is also an important element. The third important one is reasonableness of accounting estimates. As I mentioned a little while ago, everything in the financial statements, whether it's balance sheet or P&L, is made up of estimates. Your property, plant, equipment. The decommissioning cost is estimated and added to your cost of the asset. That's an estimate. Asset decommissioning 10 years later. Take, for example, I take a rented place. Office space I take on rent, and the rent agreement is for 9 years. When I leave the place after 9 years, I have done leasehold improvements by spending 3 crores. But when I leave after 9 years, I'm supposed to restore and then leave. So when I restore, I have to spend 20 lakhs or so to give it the same way as I took it. Every lease agreement will have that standard clause of restoring before you leave. So you have to estimate how much is the decommissioning cost, add it to the cost of asset. That is an estimate. Depreciation, life of the asset, is an estimate. Investments, fair value is an estimate. Inventory, NRV, is an estimate. Receivables, your provision for impairment is an estimate. Cash balance held in foreign currency, translation is an estimate. Security deposit, advances, recoverability is an estimate. Liability, provision for tax is an estimate. Provisions which you make for your staff payments, bonus, gratuity, leave encashment, all of those are estimates. So your financial statement is full of estimates. The same is true with the income statement as well. So as an auditor, before I sign off SA 700 finished product, I need to check what elements in the financial statements, whether the accounting estimates which have been taken are all reasonable. The next thing which I need to check before I finish this product, relevance. Whatever information you're giving, is it relevant? Reliability of the financial statements. Is there comparability? Can I compare with the previous period? And is it in a way you can understand? So as an auditor, I have to ensure that I'm meeting these 4 qualitative characteristics. Every information in financial statements, I have to satisfy myself if there is relevance. Is it reliable, comparable, and understandability? Is it there? The next requirement which flows out of SA 700. Please note, all of this slide is SA 700. Nothing is my addition. I am not adding a single word. Everything which you see here in this slide is SA 700. The next requirement is, are there adequate disclosures to help the user of financial statements to understand the effect of material transactions or events? So during the period, there was an amalgamation. During the period, there was a hiving off. There was impairment. So whatever is there adequate information which you are giving which will help the user to understand? Then the terminology used in financial statements, is it appropriate? Now, here again in terminologies, some people try innovation in the use of terminologies. I would strongly recommend, please don't try to innovate terminologies. Stick to terminologies which are there in the accounting standard framework. I'll give you a small example. AS 13, long-term investments. Long-term investments are always to be carried only at cost. If there is a fall in value, you make a provision. But the language for that is you make a provision for a fall which is other than temporary. It's called other than temporary. So there are many people who write that if there's a permanent diminution, we will provide. From a simplistic understanding, permanent is okay. But the correct technical language is other than temporary. there's a huge difference between the words other than temporary and permanent. There's a huge difference between the two. So everything in financial statements, it's important to ensure that the terminologies which you use are appropriate terminologies. The next is financial statements adequately describe or refer applicability the applicable financial reporting framework. This is a serious cause of concern. It I actually get very upset. I don't mind gaps anywhere else, but on this, it is very upsetting. Even today, I come across many companies where the financial statements will say, we have prepared the financial statements in accordance with the accounting standards issued by the Institute of Chartered Accountants of India. That doesn't apply at all. The standards of Institute of Chartered Accountants of India are applicable only for non-company entities. For joint stock companies, you should say in accordance with the standards notified under the Companies Act, Companies Accounting Standard Rules, so and so, so and so. So that framework part is a very important one. Very common error. People say, because in the mind it's institute standards. They say as per standards issued by the Institute of Chartered Accountants of India. That should not be the case. I told you there are 3 sets of standards. You have to carefully write which set of standards is what we have actually used. The next requirement is whether the financial statements prepared in all material respects in accordance with the applicable financial reporting framework. So whether it is the presentation requirements or the disclosure requirements, whether they are meeting the requirement of the respective set of standards. The next one is as important as the accounting estimates. The qualitative aspects of accounting practices and possible bias in management judgment. And here, engagement partners' involvement is extremely important. The audit procedures include making inquiries. And if you look at the financial statements, there are so many judgments which the management does, whether it is this receivable will be collectible or not. Is this payable likely to be the same amount or is it likely to be higher? There's so many judgments which are there. And managements will have bias. We should accept the reality that managements will have bias, and it is for us as auditors to ensure that that bias does not exist or it is brought as close as possible to zero. I'll give you an example. Take a case of the provision for gratuity. When you make a gratuity provision, if you take interest rate of 7 and discount it, the liability is so much. 7.5 and discount, the liability comes down. So the discounting rate will decide how much is your liability. There will be managements who would like to keep the profits lower, some who would like to keep it little liberal. So it is for us to recognize that managements by their role will always have some element of bias, and it is for us to ensure that they are not acting with that bias. I'll give a small example, personal example. Let's say there is something to do with within a family itself. Let's take it within a family itself. You have two children. Both children are same. Let's say two children. Both children are same. But subconsciously in our behavior, the younger child always gets a little bit of a bias. The elder fellow would not have even beaten this younger fellow. The moment younger fellow cries, as a parent, you just tilt towards the younger fellow because that bias comes. But bias comes. We like it or don't like it, but it comes. Similarly, just think of a management who's working in a company for 7 years, 15 years, 20 years, and they built their life and career around the company. For those managements, it's so natural to have that bias. That bias naturally comes. So it is for the auditor, engagement partner to say that, look, there is a potential bias in every management judgment. I have to ensure that that bias is removed. That's an important responsibility which is cast in this SA 700, which is the audit conclusions standard. This is a standard dealing with concluding the audit. You have to spend on that qualitative aspects. Next is have an understanding of materiality of uncorrected misstatements individually or aggregate. Obviously, as an auditor, we usually prepare a laundry list of 20, 30 items of what are collections to be done. Managements will do some they will say I will not do because they will have their own view. So as an auditor, I need to take a judgment. What is the materiality of such uncorrected ones individually and aggregate? What is that materiality? I need to have an assessment of the same. And then sufficient appropriate audit evidence has been obtained. You need to ensure that you have got it. And then conclude on reasonable assurance and issue the audit opinion. This is SA 700. All of these prescriptions reside inside SA 700. My experience when I was in practice, for me, this one-page chart on my table was like a Bible. Before I signed off the financial statements, go through each of the steps. It makes life very simple in terms of signing off on the audit report. Now, as far as the audit report structure is concerned, this was a change in the structure which came when SA 701 got introduced. But even today, I decided to show the old and the new. I decided to show the old and the new because even today, I come across many who still keep giving based on the old report, old format. The new format, there's a change in the sequence of the items. I will call out some of the key ones. Look at item number 3. Item number 3. It is called report on the audit of the financial statements. Just take your last year audit reports you have signed for 10 private companies, 20 private companies. Look at it. Whether the title of the report, you have added these words on the audit of the financial statements. That's one important one. The second one which I'd like to call out is this point number 8. Point number 8, where earlier it was only management responsibility, but now the audit report also draws reference to responsibility of those charged with governance, which means the audit committee. So which means when you discuss with your audit committee, you tell them that, look, it is not just the management who is responsible, it is the audit committee and consequently the board who is also responsible. So that is again an item to be called out. Now, form of opinion. I told you earlier that this deals with unmodified opinion. And modified opinion will be issued as per SA 705. I'll spend time a little later, few minutes later. And financial statements, if they are not achieving a fair presentation, you are required to, the standard requires you to discuss with the management and then modify if required, which is what I'll cover in SA 705. These are the elements of the audit report. I'll spend time on 4 things. Going concern, responsibilities of management and those charged with governments, auditor's responsibility and other reporting responsibilities. Going concern, this is an important one, and very often people reach out for some clarification on how to address this. But this is a standard SA 570, which is so beautifully drafted, and it is as simple as it looks in this chart. It's as simple as it looks in this chart. In all our firms, we will always have 1 or 2 clients who will have this going concern question. If you have 20 clients, I'm sure there will be 1 or 2 clients where there is no activity, some losses, and there will be a need for applying judgment on the going concern basis. 2 scenarios are identified. SA 570 identifies 2 scenarios. Scenario 1, where the use of going concern concept is inappropriate. So company is doing badly, it's likely to close down, etc. But they are still using the going concern concept. Where you believe it is inappropriate, you don't have a choice except to give an adverse opinion, modified opinion, adverse opinion. So first scenario, going concern is not there, but financial statements are prepared using going concern. You have to give an adverse opinion. Second situation, going concern basis is fine, but there is a material uncertainty. For example, lot of the startups are there, cash burn, etc. And they're trying some new business models. It may succeed, may not succeed. So wherever you have such situations where you feel that there is funding arrangement, etc., going concern basis is fine, but there is a question mark. You have a doubt on it. Those cases, two scenarios. One, it's adequately disclosed in financial statements. Then you can give a unmodified opinion, clean opinion, and include a separate section on 570 in the audit report. Second scenario, if it is not adequately disclosed, then you need to give a modified opinion. Then responsibilities of management for financial statements. I told you about the governance, those charged with governance also having that responsibility. Auditors' responsibilities for audit of financial statements. As far as the auditor's responsibilities are concerned, we need to get an necessary comfort for giving a reasonable assurance. And in the opinion, these are some key elements which you have to bring inside the audit report. Template is available. Template is available in the audit standard itself. You need to bring all of these things. Other reporting responsibilities, we have requirements of responsibility under the Banking Regulation Act, CARO requirements, and 143(3). Now, these are other elements. Interest of time, I'll skip them. One point I would like to highlight, signature, I'll just spend a minute. Again, very, very common mistake. Most of our cases, audit assignments are in the name of the firm. So when you get in the name of the firm, the partner's name has to be mentioned. Partner has to sign with his signature, not firm signature. The partner's membership number should be disclosed, and the firm registration, FRN, also has to be disclosed. There are many cases where partner's name and number is missing, or the FRN number is missing. So that is not acceptable. We need to give all of those elements. In SA 700 appendix, we have illustrative formats of audit report to be given for listed company, then for unlisted company, and for non-corporate entity under both the frameworks. For companies, we have only under fair presentation framework, because in India, for companies, it's always true and fair view. So it's only fair presentation framework. For non-corporate entities, you have a illustrative format for both fair presentation and the compliance framework. Now, I'll be sharing this deck with you, but I'll identify 2-3 key common mistakes which are there. In interest of time, I'll move to the next standard. The 2-3 common things. If you look at this is for a listed company. This for listed company. Firm as the auditor. Partner is given his membership number, but FRN is missing. This is another case. This is audit of a nationalized bank. And in nationalized bank and all, you have joint auditors, 3-4 auditors are there. Just look at the second one. In the case of profit and loss account, of the profits stroke loss, which means sincerely Control C, Control V has been done. Whereas in that particular report, For the year, it is either profit or it is loss. You can't copy paste and say profit stroke loss. So when we did the review, we saw maybe this year was profit, last year was loss. That was also not the case. It's just copy paste, just copy paste. And as an engagement partner, you are signing a 4-page report, 8-page report. You need to read all this because it's prepared by the staff, and it's quite possible the staff, out of ignorance, might miss out some of these things. So profit stroke loss, this is again a common error. And this is a common error where companies said they gave accounting policies for some standards, but they actually had transactions which required application of other standards as well, which they did not mention. So just look at this error. Look at this error. This is again listed company. The heading is auditor responsibility in the audit report. Under that heading, it says, in our opinion. Now, just look at it, the message we are communicating to the regulators, the government. We all get angry when the external stakeholders criticize. But when you have a situation like this, where somebody is so casual about the heading auditor's responsibility and writes that it is my opinion. And these are not isolated cases. These are cases which we come across quite frequently, and it requires a higher diligence in terms of the work which we do. This again, auditor's report, it has to be again for a bank. It has to be independent auditor's report. That's the requirement. So I'll skip these things. Now let me come to SA 705. This is a very important standard, and a standard which, particularly in the case of PSUs, I find the people have not applied it properly, because in some of the PSUs and all, the auditors want to play it very safely, and they tend to give a modified opinion. Even in the case of private enterprises, there are some cases in concern of change of auditors, etc. People tend to give a modified opinion. In this standard, we come across both situations. One, where you are supposed to give a modified opinion, but people give unmodified opinion. And cases where you are actually supposed to give an unmodified opinion, clean report, but you give a modified opinion. And when you give a modified opinion, the criteria of whether it should be qualified or adverse, that again, people have not applied it appropriately. My view in this standard, there's a small chart table which is given inside the standard. And that table is beautiful guidance. It's a beautiful guidance on how a modification has to be done. Should it be qualified? Should it be an adverse, or should it be disclaimer? And for modified opinion, there are only two things which drive whether it should be a modified opinion. I'll just go straight away to that. The two things which, this one chart is enough for SA 705, nothing else is required. Look at the left-hand side bottom. What is required is whether there is a matter which is materially misstated. Like, for example, impairment of assets not done, provision for bad debts not done, inventory verification not done, or valuation not done properly, revenue recognition not done, measurement is error, some expenses like retirement benefits not measured properly. Is there a matter which is materially misstated? So what is that item? That first thing we need to understand. Second is inability to obtain sufficient appropriate audit evidence. So these are the two situations. So what will drive a modified opinion is either there is a matter which is materially misstated, or there is no sufficient appropriate audit evidence. I'm not able to get an evidence for that. So in these two situations alone, you end up with a modified opinion. What type of modified opinion? Depends on pervasiveness. That what type of modified opinion depends on pervasiveness. So does it affect only one element, this element alone, or it affects a lot of items in the financial statements? So you need to look at the pervasiveness of the same. So the type of modified opinion, look at the decision box now. Financial statements are materially misstated, but it is not pervasive. So for example, inventory alone, it is materially misstated. Valuation is wrong, verification not done, etc. So it is misstated, it is material, but it is not pervasive. It is just affecting the inventory item in the balance sheet and the cost of goods sold figure. Those cases give a qualified opinion. It is material and pervasive. It is affecting multiple elements in the financial statements. Those cases you need to give an adverse opinion. So financial statements misstatement, material but not pervasive, qualified. Material and pervasive, then it is adverse opinion. The second situation is lack of sufficient evidence. I'll tell you what cases you don't get evidence. When you don't have evidence for one item, for some item I don't have evidence, like there's some important receivables which are goods have gone, shipment has gone, I don't have confirmation, whatever, but it is confined to that element alone, give a qualified opinion. But if you don't have evidence relating to many items in the financial statements, you have been restricted in terms of either scope or accessing financial statements. Financial books have been seized by government authorities, etc. Those cases, you need to give a disclaimer of opinion. So this one slide beautifully articulates SA 705 as to when do you give a qualified opinion, when do you give an adverse opinion, when do you give a disclaimer of opinion. Now, let's spend a little time on examples of financial statements are materially misstated. Examples of inability to obtain sufficient evidence. Let's spend a little time on those. Now, as far as nature of matter, whether materially misstated can be relating to selection of accounting policies. If there is a wrong selection of accounting policy, that's an item of material misstatement. Applying the policy wrongly, that is an item of material misstatement. Appropriateness or adequacy of disclosure of in the finance statements, that is an item of material misstatement. So material misstatement can come under any of these three. Inability to obtain sufficient appropriate audit evidence. Situations are circumstances beyond control of entity, like government has seized the books of account, not available, or there's been a fire accident, all the data has been destroyed, soft copies destroyed, no backup. So those are circumstances beyond the control of the entity. Second is circumstances relating to the nature or timing of auditors' tests and procedures. For example, somebody is appointed an auditor after the year end. There was an auditor, but he passed away or resigned, whatever. New auditor comes in the month of July, and you're auditing for year ending March 25. Auditor appointed today, 1st August, but it is for March 25. So March 25, there is no way you can do physical verification of inventory on March 25. So by the very nature of timing, you can't go and do it. So those circumstances, you don't have sufficient appropriate audit evidence. That's the second situation. Third is management themselves impose limitations. For example, Kolkata-based company, but the factories are located in Aurangabad, factories are located in Madurai, and there is a limit. The management is restricting you from visiting those locations, interacting with those locations and all. They're telling, no, here is the soft copy, you do the audit here. So if there are those limitations management is putting, you don't have enough evidence to conclude. So those are the situations of inability to obtain evidence. Pervasive effect because of either undetected or because of inability to get evidence. It can be with reference to a specific element, or it could be for multiple parts of the financial statement. So this is what we just spoke. Whatever is there in these sheets is what I've just explained to you. Now, this is an important slide you need to take cognizance of. There can be scope limitation after accepting the engagement. So auditor accepts engagement, but management imposes a scope limitation. The example which I just told you, headquarter Kolkata, factory in Aurangabad, another factory in Jaipur, they tell, no, books are here, you need not go all the way and come, and things like that. Those cases, if you feel it's likely to result in a qualified report or a disclaimer, you should first make a request to management to remove limitation. That request should be a working paper for you. If the management refuses, you have to reach out to the persons charged with governance, which is the audit committee or board, and examine whether there is a possibility to perform alternate procedures to obtain sufficient appropriate audit evidence. I'll give you one more example. I'm sure all of you come across this. There will be clients of yours who will have a 20% shareholding in some company, 30% shareholding company, who are associate entities. So these associate entities, you have to get their financial statement so that you can take your share of profits, 30% share of profit, 20%, you can take your share of profits. But those profits, if you are to pick up, you should have an understanding that those profits are reasonably reliable. So some cases, if you don't have access to the work done by others, you're not able to interact. So those cases, what do? You have to find some alternate procedures, send a checklist, say that confirm to me that these have been done. So get those things. If you are still unable to obtain the evidence, you need to see if it is pervasive. If it is pervasive or not pervasive. If it is not pervasive, you can qualify. Like the associate example, it affects only one element. It's not pervasive, qualify. But if the possible effects are pervasive, you are required to examine whether resignation is allowed or prohibited under law. If resignation is permitted, you have to resign after communicating with those charged with governance. Otherwise, if it is not allowed, you have to necessarily disclaim the opinion. You should say that I am not in a position to give the opinion and give the reasons for why you are not in a position to give the opinion. Now, these are contents which we have discussed. I'll just come to the illustrative wording. In the standard appendix, we have illustration on how do you word a qualified opinion due to material misstatement in financial statement under both framework. My sincere request and recommendation would be, anytime you give these modified reports, please stick to the language to the extent possible, which is already there in the Institute Audit Standard illustration. If you try to bring in your own words, your defense will become weak at a later stage. So there is a template available. Similarly, adverse opinion, there's a template which is given where you need to say that the financial statements do not present fair view and whatever reason for why it's an adverse opinion. Same with disclaimer of opinion. We have an illustration available. Now, let me come to SA 706. After SA 705, the most misused is SA 706. And many times I've come across auditors believing that the more emphasis of matter I give, my responsibility has come down. The more other matters I give, the responsibility has come down. The client also feels, okay, you do whatever you want, but that is not correct. If you give emphasis of matters for items which actually don't require emphasis, you are subject to action. You are subject to be questioned. Same applies with other matters also. And emphasis of matters and other matters, here again, people get confused between what is an EOM, what is other matters. EOM, emphasis of matter, should be only for, I reiterate, it should be only for those items for which there is information already in the financial statements. If it is not there in financial statements, the question of emphasis of matters does not arise. So in emphasis of matter, you should say, refer to note number 12 in notes to accounts, note number 17 in notes to accounts, relating to a tax dispute, relating to impairment, relating to provision, whatever it is. You have to give reference to that particular para in the notes to accounts. That's the first requirement of emphasis of matters. Other matters are those which have nothing to do with, information in the financial statements. So other matters is basically relating to things like some actions which have happened, which you want to bring it to the attention of the user of audit report for a better understanding, So only those items. For example, the way you went about planning the audit, the way the audit was scoped, those kind of things you can bring it in other matters. So at the cost of reiteration, emphasis of matter should be only those which are already there in notes to accounts, and you should give a reference. And on emphasis of matters, you should give reference or emphasis only for those items which are important to draw attention of the users. Many cases I've come across, particularly PSUs, people give a long list of 10 or 12 items of emphasis of matters that will kill the relevance of the audit report. You should exercise lot of judgment in terms of what should come in the emphasis of matters. And there are illustrative formats which are available in the standard. Now let me come to SA 701, which is a very important standard. This standard is now almost 7 years or 8 years or whatever experience in India. And this is a standard. Many have an impression that it is applicable only for listed companies. So it is mandatory for listed companies, but it is applicable for unlisted companies also. I'll repeat, please follow it carefully. 701 is mandatory, key audit matters mandatory for listed companies, but it is also applicable for unlisted companies. What it means is, if the auditor, when he is arriving at the conclusions, believes that there are some key audit matters he has to bring to the attention of the users, he has to do it. Whereas for listed companies, when I say mandatory, what it says is, if there are no key audit matters, you have to specifically mention that there are no key audit matters when we did the audit of financial year 24-25. So for unlisted companies, if the auditor believes there's a key audit matter, you have to bring it to attention. And please note a beautiful aspect of this standard. It says, if the management believes that this is a key audit matter to be brought in audit report, management can also ask the auditor to do it. Why would a management want a key audit matter to be added in the audit report? The reason is, in key audit matter, it's such a beautiful provision. The auditor has to explain why it is a key audit matter. Second, what steps did he take to convince herself or himself on this particular matter? The third is the conclusion as to this matter has no impact on the financial statements, etc. So as a management, when suppose I'm a construction company, percentage of complete work done and all. As a management, if the auditor is saying that I identified percentage of work done as a key audit matter and it did ABCD procedures and is satisfied myself. Look at how comforting the management will feel when they go for banks, for credit and fundraise. It gives them extra comfort. So it's from that perspective that the standard says the management, unlisted company, the management can ask the auditor to give a key audit matter. And this standard is drafted keeping in mind these five objectives. To increase transparency, to provide for a basis of conversation between management and the audit committee. So when a key audit matter comes, the management and audit committee will discuss on that item. Third is to increase attention to the disclosure. Fourth most important one is to bring the auditor to the center stage. Otherwise, audit reports, many of them see it as very templatized. Whereas with key audit matter of company X and company Y will not be the same. Ideally for company X, previous year and this year will not be same. So you actually bring life into the audit report. Without key audit matters, the audit report last year, this year look same. Company X, company Y look same. But with the key audit matters, which are applicable to that entity, that year's audit, you are bringing some life into the audit report. So it also increases the communicative value of auditor's report. That's the objective of this standard. So key audit matters, these are some statistics of how across the globe, the number of audit matters, what matters are there and all. So this deck I'm leaving, interest of time I'll not read out, but just keep a note of the type of key audit matters which come. Impairments, revenue recognition, provision for bad debts, goodwill, taxation, investments, inventory valuation. Typically, these are all the items which come in key audit matters. And my experience in India, many of us in the last 6-7 years have tried to play it safe by having 7-8 key audit matters. That is actually not the intent. That's not the intent, but everybody has gone that. Similarly, what an IT company does is, if Infosys has given 6 key audit matters, copy paste do the same thing here also. People, they have tried all those things, but I don't think that's the way the standard is to be applied. That's not the way to apply the standard. But nevertheless, I think it will take some time to mature. Key audit matters, again, like emphasis matters, have to be really key. Very important ones alone have to come and not a long list of the matters which have to come. Now, this standard, as I told you, is mandatorily applicable for listed companies. Look at that third bullet point carefully. It is also applicable in case of unlisted entities. So many of us, SA 701, private company audits, unlisted companies, we take it off our mind. But this standard is applicable even for unlisted entities in the following 2 situations, which I mentioned to you a little while ago. And on key audit matters, the way it is done is through a funnel, through a filtering process. All of us know the audit staff, they will identify 30 points. Manager will shrink it to 20 points. Director will shrink it to 10 points. Partner will shrink it eventually to 3 or 4 points. That whatever you shrink it like this, and that shrunk number is your key audit matter. That shrunk number, where the auditor actually spends additional time, additional procedures to satisfy himself, those are called key audit matters. So there will be a long list, but the engagement partner, the final partner, he applies his time, mind, additional efforts on those 3-4 elements. That 3-4 elements is your key audit matter. So it comes like a funnel from which you need to identify. So everything which goes to audit committee is not a key audit matter. There will be 4, 5, 6 points going to key audit matter. You have to filter it out, and out of that shortlist, what is that key audit matter? And this is a good picture. This and the next slide is a good picture. Key audit matters normally, if you look at our own audit experience, will normally come into these 3 categories. One, areas where there is a risk of material misstatement, which you have identified in your audit planning stage, SA 315 stage. So at your SA 315 stage, IT controls weakness. So you identify that in this company, the materials accounting weakness, in this company, the revenue recognition weakness. You identify some risk at the planning stage. That is one set of items from which you should filter. The second is significant events or transactions on the audit. Like during the year, there was a merger, there was a reorganization, there was a capital reduction, there was a buyback, there was sale of a business. So there's a change of ERP system in the year. There are some new applications got added. So there is something which has happened in the period which has impacted the way you do your audit. You increased additional procedures, etc., to solve it. The third is the areas where there are significant audit judgments which are there, where the management had to make the judgments, whether it is relating to whether impairment is required, provisioning for receivables is to be done, inventory write-off is to be done. So all those kind of areas are again areas to be looked at for evaluating what will come as key audit matters. So key audit matters will broadly come from these 3 buckets, first, second, and third bucket. From that bucket, you have to filter out and identify what are the key audit matters. And for these, there are some 8 factors which you have to do. Nature and extent of communication about the matter. Just think of in your client's mind. It can be inventory write-off. It can be some receivables write-off, impairment, whatever. Think of something like that. Nature and extent of the communication about the matter. How much you want to communicate. Importance of the matter to the user's understanding of financial statements. So how important it is from that perspective. What is the nature of the underlying accounting policy, its complexity and subjectivity? So that's the third element you should keep in mind. And nature and materiality of corrected and accumulated uncorrected misstatements. So you look at those kind of mistakes, like the percentage of completion of work done or inventory work in progress valuation. So look at what is the kind of potential misstatements which can arise. What is the extent of audit effort required to address the issue? How much difficulty you have in actually applying the audit procedures, and any control deficiencies which are there, and whether it actually involved number of considerations as part of your audit. I'll give you a small example. In insurance companies, for example, insurance company audits, actuarial valuation invariably is a key audit matter. Invariably is a key audit matter because it fulfills all of these 8 criteria which I just read out. Based on that, you identify the same. This is a little busy picture, but I would strongly recommend you to go through this. This is a picture from the International Audit Standards Board, and it beautifully captures how the entire SA 701 needs to be applied, the way I have explained the same. Now, as far as the key audit matter is concerned, I think this slide sort of summarizes what you need to do. You have to describe what the key audit matter is, and you should say, for this key audit matter, what are the disclosures in the financial statements if they are there, why you believed it is a key audit matter, and how did you address it. And for this, you should see how did the auditor carry on additional procedures, how was he satisfied, and the conclusion which he has arrived at it. So that's broadly about key audit matters. And the important things which we have to keep note for listed companies and all, if there is no key audit matter also, you are required to give a statement that there is no key audit matter. And another important point we need to keep in mind is there can be instances where the going concern is under question and you are reporting in the main audit report as per SA 570. So those cases going concern should be reported only as per 570 and not as a key audit matter. So that's a specific standard. So that reporting should come and that should not be replaced by a key audit matter. So there are templates available in this standard. So a few more minutes and I'll leave the floor. We have to do up to 7, I guess, no? 5:37, I think.
Yes, sir. Yes, sir.
Yeah,
So
okay.
we can
Just 2, 3
extend five,
minutes I'll
ten
close.
minutes, sir. No worries.
Yeah,
No
2,
worries.
3 minutes and I'll leave the floor open. Okay. SA 710 is basically about comparative information and corresponding figures. So this is a very simple standard where somebody does audit of multiple periods. It's comparative information. Otherwise, if I'm doing audit of this current period and I'm relying on the opening balances, then it is corresponding figures. So that's it. This is the important standard, last one. And in practice, many miss out on this. So I'll spend a little extra time on SA 720. In fact, this standard is applicable for unlisted companies, private companies, everyone, everyone. All of us know that financial statements eventually go and sit as part of annual report. An annual report. There is a director's report. There is corporate governance report. There is management discussion analysis. Goes and sits as part of a larger report. Even in private companies, unlisted companies, director's report, etc., are very, very commonly there. And if you look at these reports, they are also approved by the board and they go together. What happens in practice is in the director's report, it says we have investment in X Limited, which is our joint venture. So they will very innocently write that. But in the financial statements, we would have put it investment in company or leave it. Whereas the moment it's a joint venture, consolidation is applicable even if you're an unlisted company. So there is an inherent conflict between the treatment you have followed in financial statement and what is required, what you have said in the director's report. Similarly, there'll be some director's report where they'll tell we have factory located in Kenya and this factory is not performing well. We are closing down or we are thinking of closing down. So that paragraph has an impact on the impairment. So we would have missed out on impairment. So what SA 720 says is every auditor, as part of the audit conclusion, has to get a copy of the director's report or at least the draft director's report and see whether there is any conflict or not. If there's a conflict, resolve it and take next steps. If the director's report is not available, like in public sector companies, what happens is audited financial statements is done in board meeting May, director's report is done in board meeting of July. Suppose it's not available and it comes later. So when that audit report, director's report comes later, you have to collect a copy, verify, and see whether you have to modify your audit report. If you have to modify, you have to take steps for modifying the audit report as well. So that's the prescription which we have in SA 720. So SA 720 is a mandatory requirement where every auditor needs to collect all the other information which goes into annual report, and you should have working paper to say that yes, I have reviewed the other information, which is predominantly director's report. I don't find any conflict. If there's a conflict, the same has been resolved. So that's about this standard. So with this, let me pause and leave those few minutes. I thought I'll close by 6:45. I'm sorry, I've gone a little beyond. So happy to interact.
No, sir, we all are happy, I believe we all are happy to have such knowledge session from you. I'll allow all participants to unmute themselves also. So in case somebody wants to ask, they can unmute and
Yeah.
ask. There was a question, a chat related to PPTs. So one, we have shared the PPT over email and we'll again reshare the link of Google Drive is also shared. So don't worry about the PPT, just enjoy the session. So back to
Okay.
the audience in case anybody has
The couple,
questions.
yeah, the couple of questions, I'll just answer them. For SME, I don't know what is that. I think for small medium enterprises, happy to take any questions which may be there. The next
Sundarajan
one
sir can
seems,
unmute and speak if, sir.
yeah, I'll just answer what is there so that we close this chat. There's a misconception that there is a sequence of adversity of reporting like adverse, qualify, EOM, OM. Many think that a matter can be diluted by inserting a UOM instead of classification. Yeah, this is exactly what I was telling. There is nothing like this sequence and all. Giving EOM, you cannot escape qualification. EOM and modification are quite different. And in modification, whether it should be qualify or adverse, qualify or disclaimer, that table which I showed is super clear, super clear. So there is nothing like sequential and all. Misstated, not pervasive, qualify. Pervasive, adverse. Lack of evidence, not pervasive, qualify. Pervasive, disclaimer. As simple as that. Please also throw some light on group or parent auditor to carry all the EOM's qualification camps. Yeah, this is a very good question. Today, this is the entire discussion of SA 600 and NFRA and all, NFR and all. Today, the parent company auditors, normally we sort of arithmetically do the aggregation, but NFRA has clarified the same, The parent auditor has to necessarily look at all the observations of the component auditors and the context of materiality threshold of the consolidated entity. Materiality threshold of consolidated entity, you should evaluate the need for having that EOM, whether I need to carry it or not, OM we should carry it or not, or CAM I should carry it or not. So it has to be evaluated and included. And I think, yeah, that's it. That's it. Yeah.
Sundarajan sir, you can unmute and speak.
Sundarajan. Sundarajan is one phone call away and he's asking questions on the video. What, Sundarajan? RS, you are on mute actually.
Unmute. Yeah. Now I'm
Okay, okay.
unmuted.
Yeah.
Good evening, sir.
Good evening,
So it's
Sundarajan.
always a
Solunga.
pleasure to talk to you, sir, whether it is over phone or Zoom, sir. So,
Yeah.
having heard you, I thought it can be useful for others also. That's why this question. You were
Sure.
talking about this qualification and advice in respect of non-suiting to the applicable framework. So, as far as these non-corporate issues are concerned, now we are supposed to give the revised format according to this. If the client is not willing to accommodate to that format, because last year they were doing that, this year certain people are committing, agreeing all these things. In case they are not coming to commit to this framework and they want to continue in the same framework without the previous figures, etc., am I under compulsion to give a qualification or a disclaimer?
Okay.
The reason for this question is it is not according to the framework. So once it is not according to the framework, I am under a compulsion to report it. But when it is in case of a corporate, there is no complication. Everybody is willing to follow the AS and doing that.
Yeah. So two questions, Sundarajan, as I see from you. One is previous year information not being given. That is one. Second is the format prescribed by the guidance note not being followed. Okay. Now, as far as the format is concerned, it is now part of the framework. So inadequate disclosure. But if it is not changing the user's understanding materially, you can stop with giving a qualified opinion there. As far as the previous year figures not being given, that's a case where there's a complete non-compliance of the framework and you don't have evidence for you to comment on the same. That will go only to a disclaimer. But having said that, Sundarajan, I think we should wait a little. I think there is a discussion happening between the Accounting Standard Board and Audit Assurance Standard Board precisely on this point. Because see, what we should understand, Sundarajan, is the ASB's view. The Institute Council has approved the guidance note. their view is this accounting standard framework was always applicable, and rightly so. That is the correct view, always applicable. And all the financial statements, they are prepared only as per the standards. The moment you prepare as per standards, comparative information is compulsory. Not giving that. Now, for institute also has credibility and all. No? So members getting away with signing off, it doesn't look good. 70 years over and all. So I think institute is trying its best to say that let's move on. Let's move on. I think as a profession, I find some practitioners struggling on this, but I think we have to get there. My view, at least 70 to 80% of them will get there. There'll be 10-20% we should allow that and handle it later. Let them come the way. Because we can't spoil the reputation of the profession because of some 10-20% not scaling up. But thanks for bringing that question. It's useful for everyone.
Yeah. If I'm permitted to ask one more question.
Please.
See this, you were talking about this SA 600 and our component auditors. See, invariably in certain couple of occasions, what happens is this component auditors are not responding. Say, for example, there are some 10-15 component auditors are there. We are asking for certain information to be given to them and how it has been done, how they have done the materiality, etc. When the holding companies auditors are not given information about this component auditors, companies also trying to get that information, etc. But what is the real situation as far as this whole main auditor is concerned? If he is not able to get the information within by the time reporting has to be completed.
Yeah. We have to go through that situation of sufficient appropriate audit evidence. That second situation. I'll tell you why. In fact, on SA 600, my view, independent of all this NFRA and all that kind of stuff, the parent auditor is reporting on the consolidated statement. And when you're doing consolidated statement, you are talking about subsidiaries, joint ventures, mainly. And more importantly, subsidiaries. Who are subsidiaries? They are control entities. If management says, I don't have the control to get that information, it's a sad situation on the management effectiveness. So this standard is actually a responsibility of the management to ensure compliance. In fact, I was telling Sumit and Yogesh before we all started that the preparers of financial statements should actually be in these kind of sessions because they have responsibility of ensuring this. Now, trying to use the auditor's empathizing nature and pulling the auditors, those days are gone. I don't think auditors are also willing to empathize beyond a point with the practical difficulties which are there. I think managements have to be strong. If they are subsidiaries, they have to jolly well ensure that they are reporting the same. They're not getting it as auditors. I think we should go towards qualifying. And the example you gave is a beautiful example where the parent is, let's say, a holdco and subsidiary is an operating company. And that operating company you're consolidating and that is some auditor. And you are a holdco auditor which you're consolidating. And he is not giving you any information for you to get comfort. He says, I've given report, you blindly follow that. Right. That's a case of lack of sufficient appropriate audit evidence and pervasive because I don't know anything about anything. So you have to give me that. So I think that's a good example of evidence not available and pervasive. But suppose it's an associate where one associate, 20% share of profit, small profit.
Small effect, negligible.
So no evidence, material, but not pervasive.
Not pervasive.
Qualified opinion. Tiny associate, not material, not pervasive, unmodified opinion. So I think that table will give
table is definitely will be
guidance. Yeah, that's all.
Thank you, sir. Thank you very much.
Thank you, Sundarajan.
I think Vishnu has a question. Yogesh, you have some questions?
No, I don't have.
So Vishnu, you can unmute and ask.
Sir, my question was regarding audit of charitable trust, maybe slightly going beyond the topic that was discussed. So in case of non-profit organizations, how seriously the accounting standards have to be applied? And if there is any deviation in the format as compared to the technical guide issued by the ICAI, would it require any qualification in the audit report?
Vishnu, 2 points, Vishnu. One is the standards are applicable. The
Okay.
technical guide is more about the template and all. Technical guide has lower authority than a guidance note. So I think as long as basic accounting standards have been well applied and comparative figures have all been given, I don't see a reason for qualifying it. The technical guide requirements in terms of any presentation, little up and down is fine. But fundamentals which are there in terms of some corpus funds, revenue funds, etc., if there is a gap, obviously you need to qualify.
Okay, sir. Noted. Thank you.
Yeah.
So any further questions, or else we can, approach the closure of the session.
So thank you all. Thanks, Sumit, and all for hosting. It was
So
pleasure being part of it.
I'll request you to be there for next
No, I'll
month
be there.
as
I'll
well.
be there, but
So
I'll just place
Can
my
I-
thanks to all the participants as well.
Hello,
Thank
am I audible, please?
yes,
Yes, sir.
sir.
Yes, sir.
Can I ask a question, please?
Please.
बिल्कुल सर पूछिए सर.
Uh-huh. Is it the responsibility of a statutory auditor of a listed company to report on the going concern concept of the company? If
Yes,
the
sir.
going concern concept is vitiated, is it the responsibility of the auditor or the management to report that in the audit report?
Yeah. Okay. Primarily, it's the responsibility of the management, sir. If you recollect, I had one slide on SA 570. There were two scenarios. One scenario where going concern assumption is not valid, but management follows going concern. You have to necessarily give a modified opinion. Second scenario B, going concern assumption is under doubt. There's a material uncertainty which is there. In that situation, if management has made disclosures, you can give unmodified opinion. If management has not made disclosures, then auditor needs to give a modified opinion.
Thank you. Thank you, sir.
Welcome.
So, yeah, thank you
Hello,
so much.
good evening. Can I ask one question?
Please.
Yeah, please.
So I just wanted to know about a qualification if it is placed in Caro report. Let's say a company has violated the test, the NBFC test, and it is required to get itself registered. So does this qualification requires us to again carry a reporting in the main audit report as well?
No. So the main audit report qualification is with reference to the information in the financial statements. The Caro, it is basically observations of those list of questions which are there. So it's observations around that. We will give those qualified observations which are there. So it need not necessarily mean that if there is a negative observation for any of the Caro, you have to give a modified report for the finance statement. It's not necessary.
All right. Thank you for
Like for
clarifying, sir.
example, there can be some intercompany loans which are interests are not proper. There can be fixed asset records not properly maintained, inventory verification not properly done, or those kind of things are all there in that Caro. You have that long list. So negative observations there does not necessarily mean qualification here.
Okay, thank you.
Yeah, welcome.
So I think we come to the conclusion of the audit conclusion and reporting session, as well as the conclusion of the entire series of Audit Ki Pathshala. So first of all, I would thank all of you to be in this program, because it's one of the underrated topics, as well as one of the most critical and important topics. So, with I would request our president Neeraj Agarwal Bhaiya to share some words, and we have Amit Agarwal Bhaiya also, our secretary of the association, to offer a formal vote of thanks.
Thank you, Sumit. First of all, sir, thanks a lot for consenting to be part of this series of Audit Ki Pathshala and taking time out from your busy schedule. And what a wonderful session it was today. Hats off to you, explaining all these situations in such a lucid manner and the coverage which you have had in this limited time. Thanks a lot, and we look forward to more sessions from you in this matter. And again, thanks to this entire committee of VIPC Association, wherein they have curated this beautiful series of Audit Ki Pathshala 5-day series from Monday to Friday. And we have tried to cover the entire importance of audit during these days with all the best of the speakers which we had. So thanks to the team and thanks to all the participants also for time out for this series. And we would be coming with more such series going forward. So be in touch with the VIPCA communication, and I'm sure we'll be able to come out with more such useful programs for you. Over to Sumit.
Amit Bhaiya is actually facing some trouble to unmute.
Okay.
So in that case, Bhaiya, are you able to unmute? So you can speak.
Yeah, is Amit speaking?
No, it cannot be unmute.
भैया आप कैमरा ऑन करके ऐसे ही दे दीजिए, फोन से आपको वो कर लेते हैं.
फोन से आवाज आ जाएगी?
एकदम आ रहा है.
अरे वाह, very good.
आ रही Amit, carry on please.
Okay. Good evening everyone. I would like to express my sincere gratitude to all of you. A special thanks to our speaker CMP Vijay Kumar for giving his insight on audit conclusion and reporting. Sir, you have elaborated nicely different standards on auditing like SA 400, 700, 705, 706, etc. Sir, changes in auditors report structure you have mentioned, it is very useful to all the attendees. I think it will be very helpful to all the attendees. Today is the last day of Audit Ki Pathshala. We are concluding this virtual program. Finally, I would like to thank all the attendees for your participation and your support. Thank you. Thank you all.
Thank you, Amit Bhaiya. So thank you so much, sir. Thank you so much for giving us your precious time, and I hope all of us were able to learn a lot of stuff.
Thoroughly enjoyed. Thank you.
Thank you so much, sir. We'll end the call for on. Sir, please do share the PPTs because the audience.
I'm to mail, no? Okay, I'll mail it. I'll put it in the WhatsApp.
Yeah, anyways, you feel like, so we'll share the entire PPTs of all 6 days to the participants.
Yeah, next 3-4 minutes, I'll put it in the WhatsApp.
Okay, thank you so much.
3-4 minutes.
Sir. Good night.
Thank you. Good night. Thank you.
Sumit, then don't close this call now. Let him put the presentation in the WhatsApp or in this group chat, whatever is possible.